Many large institutions have their own lineup of standard index ETFs. Others are launching ETFs based upon what's called custom indexes that weight securities in ways that are different to traditional indexes. And on today's ETF battle, we've got a contest between old line indexers versus nouveau indexers. It's SoFi versus Vanguard. It's another audience requested contest. So who wins? Stick around to find out. Welcome to ETF Battles. I'm DeLegge. We're glad to have you with us. Now, today's ETF matchup, like the others we do on this program, are audience generated. That means if you have a certain ETF contest that you'd like to see, or maybe you're wondering about, well, I'm comparing this ETF versus that ETF and I'm just not sure. Well, we're here to help you. So send us your ticker symbols in the comment section below or on our Twitter feed at ETF Guide. And also check out the description section below. We've got lots of viewer resources, tools, as well as online classes. So today's ETF battle was requested by a longtime viewer named Sunny Raj. And it's a quadruple header between two SoFi ETFs going up against two Vanguard ETFs. We've got SFY versus VOO versus SFYX and VXF. Now, these ETFs are all focused on large, mid, and small company stocks. But as you're about to find out, there's some major differences in how they invest in those stocks. Judging today's high-stakes contest is Tom Psarofagis with Bloomberg and David Dierking with TheStreet.com. Guys, welcome back. Great to see you.
Likewise, Ron. Great to be back.
Yeah, thanks for having us, Ron.
So our four battle categories are cost, exposure, strategy, performance, and then the mystery. Our mystery category is where our judges can pick any factor or thing that they feel is crucial to today's contest. Our judges can also nominate wildcard ETFs if they feel there's a better choice elsewhere. I've got the scorekeeping chores, and at the end of the show, we will declare an overall battle winner based on what our judges say. Keep in mind, none of the battle outcomes are ever predetermined or known in advance by the judges or myself. Let's get started with Tom. The first category is cost. Give us your analysis.
Well, this might be an ETF battles first, but I found an ETF that's cheaper than Vanguard. Right, so VOO is only 3 basis points. SFY has 0, has no expense ratio, and actually trades pretty nicely too. It trades pretty tight, only about a penny spread, which is pretty expected. Even though we'll get to the weighting differences later, it's still large cap stock, so I expect it to trade pretty tight. It's got a lot of liquidity, and it's got no headline expense ratio. So this one is actually going to go to SFY. It trades better, and it's got a 0 fee. So one of the probably few times you can say that something's cheaper than a Vanguard fund.
Yeah, that's pretty rare. Thank you, Tom. David, you're up next. In terms of cost, how do you see it?
Yeah, I see it the same way. The only thing that I'll add to this is SFYX also has a 0% expense ratio, but it's still a very small fund. It's only got, I think, less than 50 million in assets. So spreads are still pretty wide on that one. When you add the spreads and the expense ratio together, you're actually going to probably come out behind the two Vanguard ETFs. But yeah, SFY has a 0% expense ratio too. It's trading enough that I think you can weigh it pretty evenly against VOO. I'll go with SFY as well.
That takes us next to exposure strategy. David, give us your analysis.
Yeah, VOO is based on the S&P 500. I don't think we need to spend any time on that. The big difference between VOO and SFY in the large cap area is that SFY takes the 500 largest stocks and actually tilts it towards companies that demonstrate a little more growth potential. They look at sales and net income, so that they're actually considering balance sheet characteristics when determining that. So it's got a little more of a growth tilt, but there's still about 80% overlap between SFY and VOO. So you're not getting a huge difference between those two portfolios. SFYX does the same thing as SFY, except they do it for the next 500 companies beyond the first 500. VXF is essentially the entire U.S. stock universe outside of the S&P 500. So if you add VOO and VXF together, you get the entire U.S. market. For that reason, I'd throw out the wild card of VTI, the Vanguard Total US Stock ETF, as being perhaps a better option because it essentially combines those two into one product and still has the 3 basis point expense ratio that comes with VOO. So I really think there's advantages to each one of these funds depending on what you're looking at. But I will stick with VOO as the winner here with the caveat that VTI may be the better option if you're looking for total market exposure.
Solid analysis. Thank you, David. Tom, you're up next. How do you see it when it comes to exposure strategy?
Yeah, sure. That was a great pick with VTI because really, essentially, if you put VOO and VXF together, you get that. But they brought up some good stuff. There's some interesting things you can look at both on the large cap one and then the next 500 to 1,000. So you mentioned they look at EPS growth. They're trying to identify companies that are growing faster. One thing that I maybe to the naked eye people won't notice is I think the index providers here are really important, right? Versus Vanguard, VOO is the S&P, SFY is selective. And the reason I bring this up is if you look at SFY, it has more Tesla exposure. But if you remember a couple years ago, there was an issue with Tesla got added late to the S&P 500, right? Versus selective or some of these other index providers. To me, they're more of a pure passive, meaning there's no S&P committee, there's no deciding what sort of companies get in. So I sort of like that SFY is using a different index provider than the S&P. It's not really using the committee, but then it uses that EPS growth screen. So for the large cap one, I like VOO. I think honestly it's tough to beat VOO for what you're getting for 3 basis points. The performance has been really, really close. Why I actually like SFYX over VXF in that category is I think that EPS screen would be more interesting in the second back, the 500 to 1,000 versus the top, because I think what that can do is identify growers faster than maybe the index committee can. So I actually like that approach, the EPS growth approach in SFYX over SFY. So this was split. I like VOO, and then I also like SFYX for that growth screen for the up and comers.
Excellent analysis. Thank you very much, Tom. That takes us next to performance. And Tom, you're still up, so give us your take.
Sure. So performance, VOO is holding up a little bit better. And this goes back to why I think you get so much bang for your buck for VOO for 3 basis points. And even if with no expense ratio, the performance difference overshadows that very quickly. I think there's about a 2% performance difference over the last year with SFY and VOO. Again, growth there can sometimes be a double-edged sword, and now growth hasn't been performing that well, so that's actually hurting the performance of SFY. SFYX is actually doing better than VXF, and the reason for that is has got more energy exposure. So even though we kind of look at the names like, oh, well, this is very the same fund, but really some tilts, some different sector exposures is leading to the outperformance on the SFYX. So performance, again, I'm split. I like VOO, but then I like the SoFi product for the extended market performance.
Thank you, Tom. You're up next. David, how do you see it when it comes to performance?
Yeah, I think Tom hit it pretty much right on. VOO and SFY are kind of in the same ballpark. SFYX and VXF are kind of in the same ballpark as well. Obviously, large caps have outperformed small and mid caps over time. So VOO has done better. Over the long term, obviously VOO has outperformed VXF by quite a wide margin. I think it would have been interesting to see how SFY would have performed if it had been around since around 2010, because I think that that large cap exposure with the growth tilt probably would have had it outperforming the S&P 500 over that period. But I mean, it's only been around for a couple of years now, so I guess we'll never know for sure. But based on long-term performance, I think I'm going to stick with VOO here as well.
All right. Thank you very much. Got you down for VOO. That takes us next to the mystery battle category. And this is where our judges can pick that single factor or multiple factors that they think are so important and crucial to today's showdown. So, David, what is your mystery battle category and who wins it?
Yeah, I wasn't quite sure what to call this category, so I'm just going to label it market dominance. And spoiler alert, Vanguard's going to win this one. But the angle that I wanted to take is, I mean, the ETF industry has been battling for low fees for years now, and Vanguard is obviously the winner coming coming in as the cheapest in a lot of different categories. You'd think that with that in mind, something like SoFi opening up two funds with 0% expense ratios, the flows would have just poured in on these, but they really haven't. They're only at about 400 million total assets, I think. BNY Mellon opened their own pair of 0% expense ratio funds, and they've barely gotten any traction too. So I think the takeaway here is that investors do want ultra cheap ETFs, but I think they only want ultra cheap ETFs from the well-known issuers. If it's an unknown name coming in like SoFi, I don't think investors are going to be attracted to that kind of thing. Even with JP Morgan opened up a US equity ETF a few years ago, and they came in just under Vanguard at 2 basis points. That one's been around for about 3 years, and it still only has about $1 billion in assets. And JP Morgan isn't a huge name in the ETF space, but it's big in the financial services space. So I think if you're a Vanguard or a State Street or a BlackRock and you want to cut fees, you're probably going to do very well. But I think the ultra low fee ETF space is pretty much spoken for, and companies like SoFi and BNY Mellon will probably struggle to gain traction here. So based on simply having the huge market share advantage that they can do what they want, I give it a split decision between VOO and VXF.
Thank you very much, David. And that's also called first mover advantage too, right? Besides that brand recognition. Yeah, that plays a very important role in the ETF industry. So, Tom, you're up next for your mystery battle category. Give it to us. What is it and who wins it?
Sure. And those are all good points by David on cost saturation and whatnot. And even though Vanguard is so strong, I like to see products coming from smaller issuers. I think that's really important because you just don't want BlackRock and Vanguard and being the only issuer. So I think it's important to have all these innovative products coming to market. So the category I'm looking at is the price handle, so the actual price of the ETF. So if you go and buy VOO, it's about $360, $370. The SoFi product is about $14, I think. So I think this is pretty appealing for smaller investors that maybe don't want to. I think the price handle has a psychological impact on people, and they can buy more shares of SFY. I think they can allocate a smaller amount of money than something like VOO, and I think that's a big advantage for a smaller account or someone who's just starting to get into investing. Again, the 0 expense ratio is attractive too, but I like that there's a lower price handle for it. You might see VOO split or something, but I think that's advantageous for smaller investors. So my mystery category price handle is they're going to go to both the SoFi products because they're both have a cheaper price than the VOO and VXF.
All right. Thank you very much, Tom. We got you down for SoFi. Now we move to the part of the program where our judges can give us their overall battle winner. So, Tom, you're up. Break it down.
I'm split on this one. I think VOO is it's too good of a deal. It's Vanguard. It's 3 basis points. I get it. That's a tough product to dislodge if you're somebody new. And then my other pick is I like SFYX. I think in terms of the extended market, if you're not just looking at the 500 names, I like that EPS screen. I think it's going to be able to pick up some of the growers faster than what another index approach could. So I'm split. I'll give the top 500 to VOO, and I'll give the next tier to SFYX.
David, your final chance to give us your overall battle winner?
Yeah, I'll give the win to VOO as well, but I'm in agreement with Tom here. I think it's actually closer than you might think because VXF is essentially the same thing as VOO, but you're looking at mid caps and small caps. So if that's the area of the market that you want to target, there's nothing wrong with going with that fund. I do like the fact that the SoFi ETFs obviously come in with the 0% expense ratios, but I do like that they have kind of that growth tilt to it. I think over the long term that might play out well, even if it's not playing out well right now. So, investors who want to take that approach, I think there's probably nothing wrong with SFY or SFYX. But in the end, I think VOO is just the product to go with. It's cheap, it's liquid, it covers the entire large cap market. So I'll choose VOO, but again, you could choose VTI if you want just total market exposure through Vanguard, or even VT, the Vanguard Total World Stock ETF, sort of takes the same approach, but you get global exposure as well. So either one of those funds along with VOO, I think would be a great choice for investors.
Well, our judges have spoken, and according to my battle scorecard, today's winner is a split decision between VOO and SFYX, and our judges had some awesome points. David mentioning, well, if you marry VOO with VXF, you can get that same trade with one ticker, VTI. And of course, both judges agreeing that, the cost for the SoFi ETF was a little bit lower. SFY, obviously 0 is as low as you can go. You can't go much lower than the basement, right? But the other thing, too, I would say that's sort of an outlier that was not mentioned is options. So if you're trading options or doing strategies like covered calls, you're probably going to see a little more action in the options chains with VOO and VXF, just by fact that they've been around longer, and they also have more trading activity, daily trading activity. But our judges again made some great points. Of course, the SoFi ETFs in this particular contest leaning more towards those growth-oriented types of stocks. Tom liking that growth tilt for SFYX for those mid-cap and smaller company stocks. And again, great job, judges, breaking it down for our audience and making some great arguments and some great points. So keep up the good work, and we look forward to having you guys back.
Yeah, this was great. Thanks for having me.
Yeah, thanks for having us, Ron.
Be sure to visit the description section below with research links to our judges. Get in touch. And while you're there, also check out our viewer resources section. We've got online classes, we've got tools, and a weekly newsletter. So which ETF battle would you like to see in our next episode? Post your ETF ticker symbols in the comment section below or on our Twitter feed at ETF Guide. If we choose your battle, you win your choice of an ETF Battle shirt or a coffee mug. I'm Ron DeLegge. Thanks for watching. We'll see you next time.